ARK Innovation's ETF, ARKK, is the hottest fund on planet Earth. Over the last 12 months, ending February 12, 2021, it is up 218%, compared with just 24% for the S&P 500, as represented by ETF SPY. Interest in the fund has soared. At the beginning of 2020, ARK had just $1.86 billion in assets under management. As of Friday, the fund was managing nearly $28 billion. The fund's AUM is up 1,090% over the last 12 months alone. In this video, we're going to dive into history to see if there are any parallels to ARKK. We'll look at what ARKK has in common with a Fidelity fund from 1965. We'll see what ARKK has in common with a fund that lost 99.2% of its AUM in 5 years. We'll look at the historical performance of the hottest funds. And then finally, at the end of the video, we'll look at what history predicts about ARKK's performance over the next decade. The Fidelity Capital Fund nearly doubled the return of the market from 1958 to 1965. Its returns were 296% compared to just 166% for more conservative equity funds. Its manager, Jerry Tsai, became a celebrity. A 2008 New York Times article described what it was like in the mid-1960s. People were dazzled by his swashbuckling forays into the glamour stocks of the day, which seemed only to go up, and his seeming ability to time the market's every move. It was a beautiful thing to watch. Nobody had ever run a fund like that before, and the press in particular portrayed him as an investing genius. He was the first fund manager to receive celebrity treatment in the press. Sounds like Cathie Wood, doesn't it? Just like her, Jerry's legend grew almost as fast as his fund, which ballooned from $1 billion in 1946 to $35 billion under management. In 1965, Tsai sold his stake in the Fidelity Capital Fund and started his own fund. He sought to raise $25 million for a new fund. He ended up getting 10 times that amount, or $250 million. That was Tsai's peak. Investors who bought into the hype got crushed. By 1968, the Manhattan Fund was the 6th worst performing fund in the country. Tsai sold his stake in the fund to an insurance company for $30 million, while he continued to manage the fund. Over the next 12 months, the fund would go on to lose 90% of its value. Another hot-performing fund gained its status during the worst financial crisis since the Great Depression. The Mainstay Marketfield Fund, ticker symbol MFLDX, declined by just 13% in 2008 versus the S&P 500 down 38%. Mainstay again outperformed the market in 2009. For the 2-year period starting August 2008, the fund was up 21.2%, while the S&P 500 was down 8.5%. Investors were gun-shy after the big market sell-off and were looking for a fund that could get market-beating returns but take less than average risk to get it. To start 2008, the fund managed less than $6 million. By early 2014, assets had reached $24 billion. Unfortunately, the fund's stellar performance did not continue. Investors who bought into the fund's newfound popularity were rewarded with poor returns. Since March of 2014, when the assets under management peaked, the fund has underperformed the S&P 500 badly, returning just 18.5% compared to the market's up nearly 150%. Assets under management have declined by 99.2% since they peaked in March of 2014. You may not have heard of Mainstay, but you surely have heard of gold. Gold surged in price from 2009 to 2011 as fears of a double-dip recession took hold amidst concerns that government deficits would lead to inflation. Investors were buying risk-off assets, and gold was a popular choice. So popular, in fact, that the GLD ETF became the largest ETF in the world for a very brief time in August of 2011. But just like in our past examples, investors who rushed into gold at this time period were not rewarded with good returns. Since then, the gold ETF has delivered negative 5.2% returns, while the S&P 500 has went on to generate 321.4% over that same time period. And these are not isolated incidents. Research consistently shows that large fund inflows are bad for future performance. ARK has been a fantastic investment over the last few years. It is possible that will continue. Maybe Cathie Wood is the next Peter Lynch or Warren Buffett, but I doubt it. Given the enthusiasm for her and her fund and the massive increase in assets under management, it does not seem likely that it will continue. No one outperforms forever. Cathie Wood and ARKK have been riding an incredible wave of outperformance, but history suggests that won't last. Eventually, her fund is going to go through a tough time, and when it does, many of the same people that have been buying it on the way up are going to sell it on the way down. AUM will flood out. A 2007 study found that a fund's future outperformance declined by between 0.36 and 0.94% for every 10% increase in the fund's assets under management. History suggests that over the next decade, ARKK will likely underperform the S&P 500. With such massive increase in assets, one study suggests it will likely underperform in the future by between 39% and 102%.